Welcome to This Week in Venture Capital. It's a special edition of the show. We're shooting live from Austin, Texas at the South by Southwest conference. We're shooting at the Social Media Club. And if you want to know more about it, it's a nonprofit organization that helps people become aware of social media and broadening it for the people who don't have the same digital access that you probably do. It's socialmediaclub.org. My guest on today's show is Dave McClure.
Hello, Mark.
And I expect to hear the F word at least once today. And by the F word, I don't necessarily mean I Facebooked your mom, one of my favorite shirts.
You're the one with the family.
So my shirt says, fucking social media, how does it work?
Just for the record, first F-bomb came out of his mouth.
It did. And but only in the context of reading the advertisement on my shirt for a company called Awesome. But I agreed with any of my portfolio companies I would wear a shirt for every day I was here. So that's my plan. And Facebook's probably one of your portfolio companies, is it?
Indirectly, I guess, when I used to work for Founders Fund, they were an investor in Facebook. I've done a little work with Facebook over the years.
Just a little.
Not ever directly for them.
Cool. Well, what we're going to do is we're going to talk a little bit about your background.
Sure.
What led you? I think everybody knows now you've got 500 startups, and we're going to talk about
only 100 so far.
You've got a company called 500 Startups, of which you have 20%. What are you going to do when you cross 500? By the way,
we might have to change the name.
Yeah.
I don't know.
So you're at 20% capacity. But what I want to do is let people know a little bit more about your background, because a lot of your journey, I think, is what led you to a lot of your decisions of how you do 500 Startups. Talk about what you did out of school. You went to college where?
Went to college at Hopkins.
Okay.
Actually came out to Silicon Valley, San Francisco in '89.
Yeah.
Just in time for the quake.
Right.
At the time, I was a programmer and database developer.
Okay.
And basically a geek.
You studied comp sci undergrad, or?
Mostly graduated with a mathematical sciences degree, but mostly computer science and programming.
Okay.
And I was a geek for the first 5 to 10 years I was out here.
What did you do in those first 5 years?
Mostly did a lot of programming in Sybase, SQL backend, some Visual Basic programming.
Okay.
I pretty soon discovered I really couldn't work for anybody for a long period of time, so I started my own consulting company, did some work for Microsoft, for Intel, for Netscape.
Right.
And was still learning the ropes on that, but we got a small acquisition out of that in '98.
Okay.
And then stayed for a few more years through subsequent acquisition. And then kind of late '90s was involved in all the heyday .com stuff, and that was a little insane. Ended up at PayPal in 2001.
Right.
And
in your experiences before then, though, like the 10 years leading up to PayPal, did you do startup stuff, consulting stuff, or big company stuff, or a little bit of all that?
A little bit of all of that. Mostly consulting, either independently or working for a company that was doing consulting, and then some with Microsoft and Intel.
And by the time you started with PayPal, you said it was 2001?
2001 is actually when I joined PayPal. Yeah.
And were you still cutting code? Were you still a developer? Do you still have hands-on skills?
No, I was mostly. I stopped coding on a daily basis late '90s, but I was still pretty much involved in the tech community. Ran a lot of user groups and conferences. But I was doing technology evangelism, basically merchant education and developer education around PayPal tools and services.
Give us a sense of the size and scale of PayPal when you joined. Was it already a big company?
Pretty large, but still, maybe 200, 250 people in the company in Palo Alto, not counting customer service in other areas.
Yeah.
But I joined pretty soon, right before they went public, and really, amazing time to join PayPal. It was pretty tough days in the Valley for any place that wasn't PayPal or Google or maybe eBay or.
Because the .com had already crashed.
.com had already crashed. Yeah, a lot of people who came out, in the late '90s left in the early 2000s.
Yeah.
But PayPal was an amazing place, was growing rapidly, and was really a tremendous opportunity for me early in my career.
Okay. And your job there was exactly to do what?
Geek evangelism. In fact,
What does that mean? Is that a marketing job? Is that a?
Well, I was hired as director of marketing, and I changed my title to director of geek marketing because I wasn't sure I was going to have any cred with the developer community.
Right.
And mostly it was just really learning and understanding what people were doing with the PayPal platform, and then trying to help guide more education and awareness of the tools we were making available.
Did they have an open API by then?
They did. In fact, they had an API that was literally 7 to 10 lines of HTML, which I put on the back of a T-shirt that I ran for our first developer conference.
Okay.
So we always used to claim that you could fit the PayPal API on the back of a T-shirt and get up and running in about 3 minutes.
Okay. And how big was the community? How many third-party developers?
We had a community of maybe between 250,000 to 500,000 merchant and developers, from the very smallest, somebody using front page to do PayPal buttons, all the way up to sort of the Microsofts and Adobes and Macromedias. So large number of people, but people that were working primarily with HTML to do e-commerce solutions, and then also some ISPs and shopping carts.
Okay. And one of the things that's become a big deal by 2011 now where we are platforms.
Yeah.
And we know that
Wish they'd been as sexy then when I was there.
Yeah, exactly. PayPal did okay.
We did all right.
And platforms, if you can become a platform,
yeah,
you're sort of made, right? Like if everyone's building on your ecosystem.
Depends what we mean by platform. And I typically define
you become a well-established platform.
Yeah. Well, I mean, platforms to me are features, users, money.
Okay.
And a lot of times the Silicon Valley and geek community gets too stuck on the feature side of it.
Okay.
The users and the money side are actually pretty important.
Okay.
And some platforms these days, I think, are doing the users and distribution side great. They're still figuring out the monetization side.
Right. What advice would you give to companies that want to develop an open platform, an open API? What advice would you give them on not just technically startups or
big companies
or more established companies in terms of how does one build an effective community?
I mean, I think being able to produce your feature set in API form is very helpful to startups, but oftentimes, I think startups that want to be a platform just because they think platform is sexy cool is
let's take
a difficult prospect.
Let's take a case study, okay? Because then you can talk about something real.
Sure.
Twilio.
So Twilio is the exception. They've done great with becoming a platform.
Twilio seems to have captured everyone's imagination. Anyone who wants to build out base level telecommunication services, sending out SMS or doing other things.
Voice and SMS.
Voice.
And
that is a hook or part of their product rather than building themselves, they can hook into the Twilio platform.
Yep.
Now you're an investor in Twilio.
In fact, I was the first investor when I did the seed round out of Founders Fund, and we're an investor in the B round with Union Square and Bessemer out of 500 startups.
Other than having a product that resonates with companies, which is an obvious starting point.
Right.
What other things has Jeff and the team done right that's really helped adoption for them?
Well, I mean, a couple of things. One is, Jeff came out of Amazon, had a lot of familiarity with Amazon Web Services, so he knows how to build, enterprise class infrastructure and platforms, which not every startup knows how to do.
Yeah.
But at the same time, I think they had a really, tremendous sensibility for making complex APIs simple and understanding how to market and, communicate that to the developer community and to the enterprise community. And they've succeeded fabulously well. I would say, much better than many other players who've been around longer or who are larger, who I think didn't, understand how to talk to the developer community, or as I like to say, doesn't know how to speak geek.
Right.
And they just make that really refreshingly simple and easy, and yet it's also a very powerful platform.
Do you think it's important to put out clear statements as a platform provider about where you see yourself both taking the platform but also your core product? Because I guess what you're asking is people to build their companies and take risks around your platform, and knowing where the white space is and where they can build that you're not going to crush, I think is an important part of that.
And for startups, I think there's question marks around what's the stability and long-term viability of the company. One of the things I think a lot of startups forget to do is put their business model in the API. So just making your feature set available via the API might get you usage and distribution, but it might not make you any money.
Right. So you think you need to charge for consumption of services?
I do think it's important to try and identify who's going to pay for your service, whether that's a startup that's just offering a normal service, or whether you're doing that via API.
Yeah.
Maybe you do some special stuff via BizDev. At the larger scale, I mean, I think that's been an issue for Facebook in the past and for Twitter right now is, figuring out what's the core service that the platform makes money on.
Right.
Because offering a great feature set or even a great feature set in distribution can be, a challenge for the ecosystem to understand, what can they do and not do, and when is the platform going to step on them, if they do something that ultimately becomes a source of revenue that the platform wants.
One of the things I found, because, I had sold my company to Salesforce and got to see it from the inside, that I thought we were particularly effective at, is we would do a 1-year roadmap. We did do a 2-year roadmap, but a 1 year that was pretty baked.
Yeah.
And we knew where our gaps were relative to competition. Mm-hmm. So we would regularly go out to the community and say, if you want to fill anything in these gaps, we're not likely to do it for, let's say you've got a year and a half.
I mean, that's excellent communication if you feel comfortable sort of being able to say that.
Oh, they did. As a public company, they did. They didn't guarantee anything.
Right.
But they said, here are some areas where we think there's a lot of openness in the offering. Yeah. And they would, if they started to want to encroach on an area, which is naturally going to happen in a platform community, they would tip people off well in advance. Yeah. It's all nods and winks, but it's kind of like 9 to 12 months from now, you might want to start moving your business this way.
So, I mean, I think that's the biggest criticism. I mean, don't get me wrong, Facebook's done a ton of things right, and I think they're pretty much, the juggernaut in the industry right now. But I think the issues on monetization and distribution previously were a real challenge for, companies like Slide and Rock You to navigate, and for Zynga, particularly until they reached sort of détente. Yeah. Which is now a great story for both companies, but I think for a long time was very unclear, whether Zynga would be either forced off the platform or litigated off the platform.
Right. Are you an investor in Mashery?
I am, personal investor in Mashery from way back.
Mashery is a company I find very interesting. The idea of Mashery is instead of building your own APIs necessarily yourself behind your firewall, you have a set of API services in the cloud that you can then build on a tool set for other people. Right. Is that something that you think will be a continuing trend?
Yeah, I mean, I think so. I think Mashery's business model moved from the developer community to more the enterprise community in the last few years, as they, sort of found there were a lot of larger companies that were trying to, APIs their company. Yeah. And for many of them, that wasn't second nature, and so being able to go to somebody who's familiar with that and helping them build that out was actually got them to market quicker.
I mean, I know they have American Express and Best Buy and a few other big people. Do you think they can? Will it ever resonate in the developer community, or do you think the developer community always wants to keep APIs as a core function?
I mean, I think they have lots of startups and developers. That may not be the majority of Mashery's business, but I think they definitely offer services to that community as well. Yeah. I think there's growing acceptance for sort of APIs and platforms, either inside or outside the firewall being part of everyday business, and SaaS and APIs. Kind of go hand in hand in a lot of ways.
We spent a lot of time at my two companies developing a set of, first it was APIs, then it was web services to make our stuff discoverable. And I would have loved to just have a tool set and let someone else do that.
So, I mean, that's pretty much, Twilio's business model is mostly, APIs. They charge for usage. Yeah. So very straightforward to them. When people use their product, they pay for it. Yeah. Very, value added for them. Most of the other companies that we've invested in there also do a similar thing. So SendGrid on deliverability, email deliverability.
You're an investor in SendGrid?
Yep. And Recurly for payment services, recurring billing services also. So.
Okay. And you left PayPal when?
2004. Actually, was there for about 3 years. Okay. And
what led you to leave?
I think eBay. So PayPal had gone public, and then eBay acquired the company. There's certainly a lot of great people there and a lot of opportunity, but I'm not typically a big company guy, and a lot of. I think the rest of the market in 2004 was starting to, warm up again. There are a lot of really interesting startups around, and I joined some folks at Simply Hired, which is a job search engine, and helped run marketing and launch the company in 2005.
Okay. And when did you start doing this uber early stage startup evangelist? Because I know you were teaching some classes at Stanford, if I'm not mistaken.
Taught a class with BJ Fogg on, I guess, the nation's first ever Facebook class, if you want to talk about it that way, in 2007. Yeah. Right after Facebook platform had launched. So I started doing angel investing when I left PayPal in 2004, and probably didn't really know what I was doing for the first few years there, but became an investor in Simply Hired, which I think is going to do very well.
Yeah.
And then also did some consulting work with Mint, became an investor there.
Okay.
And really decided I liked that side of the business. So instead of jumping back into an operational role, sort of slid more into the investing world, but at the same time was doing a lot of education and conference work as well.
And if I'm not mistaken, you were doing the early stage investing for Founders Fund.
Yep.
You had a role helping run almost an incubator, which was the Facebook Fund, where they had at least 2 classes went through the program that you ran.
I ran the class in 2009. There were 2 previous years that were mostly grant-based structure. It wasn't really an incubator structure. So when I took it over, we kind of changed it into more of the incubation role and had a physical, structure.
Is that what gave you the idea for how you're now doing 500 startups?
Yeah, in fact, so both running FF Angel, which was the internal angel fund for Founders Fund, which was, doing $100,000 size investments, and also FB Fund, which was a JV with Excel and Founders Fund and Facebook, more at the incubator level, probably $25,000, $35,000 checks. That was a very platform-focused investment structure. But those 2 things kind of became, what we're doing at 500 Startups. So really doing it incubation, doing it seed, and then eventually following on at A and B as well, even though I wasn't doing that role when I was at Founders Fund. Now we are doing follow-on investment.
When did you decide that you wanted to do your own fund?
I think probably a long time ago.
Is it that you were unemployable?
Probably, that's a good reason. Yeah, exactly. I couldn't get a job anywhere else. I've been in the Valley for probably 20 years, and I sort of, it took me a while to figure out how the Valley operated. So I've been a programmer, I've been an entrepreneur, I've been a marketer, I've sort of been an angel investor. I kind of had a little bit of a look at each, part of the elephant.
Right.
And I guess I didn't want it to be quite so damn hard for everybody else.
Yeah.
And I felt like there was ways that it could be improved a lot. So I first started trying to raise my own fund in 2008.
Okay.
Right when the market went through the shitter, so that was
timing.
not good timing. And then Sean Parker pulled me into Founders Fund, and I ran their program for about a little over a year.
Okay.
And then they were kind enough to sort of help me off the ground with a new vehicle.
So I know what's publicly reported, which is as a venture fund, you file with the SEC, is it? It says that you have the objective to raise a $30 million fund. So that's, at a minimum, we know that's your ambition.
That would be the target. I'm not especially supposed to comment on that, but
you don't have to comment.
That would be the target, not necessarily the actual.
I read that you were planning to raise a $30 million fund. As I tell people privately, and I won't comment on your fund, but when you do that filing, that doesn't necessarily mean that you've got all $30 million. So what often happens, and I won't ask you about your particular case here, but just so that anyone watching understands, often as a VC, you'll do a first close. And what's different about VC, or you can even do a rolling close, which means you do continual closes. But what's different about VC is when you raise money as a startup, you're typically raising from 1 to 5 people. When we raise money as VCs, we might be raising from 40, 50, 60 people. So if you think you have a hard time herding cats, I mean, it's herding cats for us. So somewhere along the way, we'll do what's called a first close. So in our last fund, I think our first close was about $135 million.
Nice job.
Second close came close to $200 million.
Right.
And so you're either fully funded or possibly somewhere in that process that you wouldn't comment on.
We have some money in the bank.
You have enough money that I noticed you've been making investments, which is good.
We were hot out of the gate, pretty much right last summer.
Okay. Talk about your model. Is 500 startups spray and pray?
Are we spray and pray? Absolutely.
Okay. You're gonna embrace it.
Well, I mean, I think the term is a bit, loaded.
Let's dissect it.
Yeah.
What do you do at 500 startups?
Well, we do make a lot of investments. So I would definitely agree that, I'm certainly, with a name like 500 Startups, I'm not going to dissemble that we plan to make a lot of investments.
You've laid out your stall.
And we're probably going to do around 100 investments per year.
Per year?
At least out of the first fund, we'll probably do 200 companies.
Okay.
But I think some people are under the impression that we do that without a filter, and some people are under the impression we don't follow on, which is absolutely not correct.
Okay.
So just to maybe be clear, we'll probably do 200 companies at incubation and seed. We'll probably do 50 of those at Series A, and we'll probably do 25 at Series B. So in the end, we end up looking a lot like other funds that have maybe 25 holdings later.
Let's just talk logistics, okay?
Yeah.
If you're going to do 100 a year, let's call it almost every third day you're doing an investment.
It might be batched.
How do you read all the legal? I mean, do you standardize? Like, can you do? Do you do classes like Y Combinator where you'll say we'll have 12
Right.
companies starting?
Yeah. So I mean, just again to clarify, we're kind of a hybrid approach between an incubator and a seed fund.
Okay.
So we have 10,000 square foot facility in Mountain View.
Okay.
In heart of Silicon Valley. We do right now we have about 12 companies in that program. We'll run like maybe 3 programs a year.
Yeah.
So that is similar in some ways to Y Combinator and Techstars.
And you have Sam Rosen in there now. Am I allowed to comment on
Sam, yes, Sam from Speakergram.
He's a great guy.
Hi, Sam.
Yeah. I was talking to him. I was so keen for him to move to Silicon Valley. I wasn't even pitching on LA because he's so full of passion and enthusiasm and wants to do a startup.
He is the epitome of New York hustle.
Yeah, he really is. But is he part of?
He's part of our Accelerator program, yes.
And so he's in a class structure?
It's not super formal in that way, but yes, we are in kind of a structured program that lasts about 10 to 13 weeks, and we have speakers, and there is a process.
But therefore, do you have a standardized legal agreement? Because what I'm trying to figure out is, I struggle to process a deal every few months, like just reading all the legals.
I think your deals are a little bit more complicated than mine.
Okay.
Obviously, they're a little later stage, and you may have more terms and negotiation to get into.
Right. But often, just to be clear, because I don't want to sound like I layer on a bunch of complicated terms, which I don't, I've got to read and process what came before me.
Yes.
Understand that, and then figure out how my deal will integrate with that, and it takes time. We
usually don't have as much previous investor kind of activity, so we're usually first check-in, or there might be...
do you have an in-house lawyer, or do you have...
we work with Gunderson, and we do a very high volume of deals, and they've been great to help us, make sure that we do that in a very streamlined and cost-efficient manner.
Okay.
And we don't charge our companies for that. We pick up the tab on that.
You do?
On the corporation side, the company will pick it up, but we don't charge our companies for financings.
Okay.
Which I think is actually not good practice, and I think the industry needs to change that. Okay. But just to clarify, so we do 2 forms of investment at the Accelerator. We do either typically a $50,000 investment on a $1 million valuation structure, so basically 5%. That's a little bit more generous than YC and Techstars.
Okay.
And then we also alternatively may do a convertible note or investment in a company if there's previous investors that have already set a valuation, and we trust that those investors are reputable and have their shit together and are not out of bounds on kind of what the structure is.
How do you differentiate your fund? I mean, someone recently said you were like SV Angel. Which you think
I have a tremendous amount of respect for Ron and David Lee, but I'd say we're pretty different from SV Angel, except that we do a large number of investments as they also do.
Well, to be fair, because I don't want to create any controversy, like I'm not about the controversy, let's just focus on what you do that's different than industry, let's say. Okay,
well, so we do investments in what I would consider to be more revenue-focused, less growth-focused companies. Okay. That's not always the case. And you might think of us as kind of the Moneyball for startups. That's a post that I actually wrote.
Okay, yeah.
If Sequoia is the Yankees, we're the Oakland A's, right? Or if somebody else out there is going to be Barry Bonds or Albert Pujols, we're Ichiro.
So to anyone that isn't a baseball fan, I'm sure this is gibberish. But the book Moneyball by Michael Lewis is a phenomenal read.
Right.
And it's about data-driven approach to baseball.
Exactly.
And how to underpay for a reasonably talented team.
I would not say underpay. I would say fairly pay.
Okay. Let's say it differently. It's how do you find the players who, based on the data, are likely to perform well relative to not having to have a bidding war for them.
Right, and I think we make the analogy that we like to hit singles and doubles, and that probably translates in our world to $25 to $250 million sort of exits.
Right.
Not that we don't like to be part of larger stories, but we think it's actually easier to build businesses because you can focus better on the customer.
Right.
And I think the market activity that's going on right now is typically acquisitions that are south of $250 million.
We just looked at the numbers, and I'm fairly certain this is right. Between 1996 to 2010,
Right.
there were only, but it's still a lot, 160 companies that sold north of $1 billion or exited north of $1
Right.
billion. So people
I would
might
imagine
think,
there's probably 10 times that many or more that sold below 250 million.
for sure.
Yeah.
And so this idea of creating $1 billion company, we read about Facebook, we read about Twitter, we read about
Right.
Zynga. It's pretty hard to achieve
Awesome
that.
story, and those entrepreneurs are fabulous, but
It's hard to achieve.
we like to get good at technical hitting, and we like to get on base, and maybe we steal second a couple times.
But people thinking of, you're the Ricky Henderson of
Exactly.
venture investing. People thinking about approaching you should have a revenue bias.
I think so, or at least a clear business model. So, one of the things we would say is that, we're a lot more operationally focused than most other VCs. So
Okay.
I have a programming and marketing background. My other junior partner, Christine, came out of Google and YouTube. She has a product marketing background. Enrique Allen, who came to us from Stanford, has a design background.
He's the guy with the really long hair.
He is,
Yeah.
yes.
He was at Geeks on a Plane, wasn't he?
He was.
Yeah, I thought I met him there. I saw him last night.
He also helped me run the Facebook Fund
Okay.
in 2009, and he was in our class
Yeah.
that I taught at Stanford
Okay.
in Facebook.
Or maybe I met him at the Facebook day, but I
Yeah.
had met him before.
So we also have web design and UX resources on staff,
Okay.
and we have a network of over 120 mentors in Silicon Valley and around the world, who mostly come from engineering, design, and marketing
It
backgrounds.
seems like one of the most critical missing skills and one of the hardest people to hire these days are UX
Yeah,
designers.
right.
Is that fair?
Absolutely.
And so that's part of what you do that differentiates, like you
Yep.
have an almost on-staff team that helps with that?
Yeah, and so classic example of that, Jason Patorti, who was the lead designer at Mint.com. I had the good fortune to work with Jason when I was doing some consulting with Mint.
Yeah.
And he's also one of our advisors and also the founder of a company, Vodazin, that we invested in.
Okay.
And it was really clear up front,
When he pitched it to you, did he say, we're going to be the Mint of? I did that for
well, as an
we want to be
investor,
the Mint.com of.
as an investor in 3 former Mint entrepreneurs, I
Yeah.
feel like that's the next new mafia coming up.
There you
So
go.
I like investing in Mint folks.
Yeah.
But Jason is one of those very talented people who has both visual design, graphic design, and interaction front-end programming skills.
Right.
And he's tremendously valuable as a resource to the companies he works with.
Okay.
And we think that that's, particularly with consumer internet really being in vogue and companies like Apple making simplicity and experience really important. It's as important, in fact, arguably in some cases more important, to have design talent on staff as much as engineering talent,
Okay.
and also marketing and distribution talent. So, we make a big deal about saying design, data, and distribution are the kind of core concepts of 500 startups.
Right.
And we try and both find founders with those skill sets, develop resources on our staff, recruit mentors with those skills, and then we actually even run conferences on those topics as well.
So how does someone get access to 500 Star? How do they get access to Dave McClure? Or do you have a staff of people that they can submit to anybody?
Well, in general, we
Or do you
don't
have
have
pitch days, or how do you?
we do, have people who pitch us, and that's part of the industry. But we're trying to develop a different model that's not based on applications.
Yeah.
Because we have a very large network of mentors and founders, there's really over 250 people in our network that you can approach to get into the 500 family.
Right.
And we like them to come through those avenues because we often have domain experts in those areas that understand more about, a business in financial services or business in, APIs and platforms, or in family and parent and education markets, which is something we're looking at. So generally speaking, if someone wants to approach us, we say find a founder, find a mentor, that we've recruited or funded in the area that you're looking for, and pitch them.
How many mentors do you have?
Over 120 right now.
120.
Yep.
What do they get out of it?
They get exposure to some of the best companies in Silicon Valley and around the world. They get a chance to keep their hand in on innovation, and I think a lot of Silicon Valley culture is about giving back.
Yeah.
They may get advisory shares. They may, in some cases, choose to invest, maybe even join the company, but I don't think that's the primary motivation. In general, most of our mentors are not investors. There's a few, but that's the minority.
The way you talk about 500 startups, and you may run from this definition, you may not, but it sounds like an incubator. It sounds like, I mean, you can never pigeonhole something, but it sounds more akin to Techstars or...
There's some aspects of that, yeah. I mean, I think, just to be clear, I mean, we're running an accelerator program, but that isn't the majority of the investments that we've made. We've done 12 investments in that program. We've done about 80 or 90 otherwise at seed and Series A and B. In the future, I'd say it'll probably be about 50-50 in the incubation program versus the not incubation program.
Okay.
So whether or not we're putting people through a more formal structure or whether that's not something that they want, we try and be quick about making decisions and about investing. And then we try and make available a network of resources that they can opt into, some more than others, in the areas that they're interested in.
What about people outside Silicon Valley? I mean, I presume you'll invest outside the Valley. What percentage of your deals?
We do. So probably about 60 to 65% of our deals are in 10, 20-mile radius of Silicon Valley and San Francisco.
Okay.
We have about 25 companies in the rest of the U.S., large base in New York and Seattle, but also in L.A., in Chicago, in Boston, and even Atlanta and Austin. We have a couple of companies here. Josh Baer, other inbox here.
Yes, I'm seeing him tonight.
And then we have, this is more originally personal preference, but now part of strategy. We have about 10 or 12 companies outside the U.S., 4 in Asia, 6 or 7 in the UK and EU, and now 2 in Canada.
How do you deal with legal framework? How do you deal with understanding the investment laws and...
Well, I mean, typically when we're investing outside the country, we're usually doing that with an investment partner that's local.
Okay.
But also when we set up the fund, we designed it explicitly to be able to invest in some countries around the world. I think we're sort of set up to invest in 7 or 8 geographies.
Okay.
And a lot of that is just because we see the global market for the internet really becoming more and more global, and our companies here in the U.S. have expansion distribution opportunities in Asia and Europe. We have other companies in Asia and Europe who might want to come to the U.S.
Right.
And really talent is everywhere. We see a lot of people, some really amazing companies out of Japan and China, and also out of Eastern Europe.
Do you get cross-country, cross-company fertilization of ideas? I mean, are your Asian people even talking to the people in San Francisco?
They are. We have pretty extensive networks, both via email lists and via physical meetups in those countries. You're probably familiar with Geeks on a Plane that we've taken to Asia a couple times, in Europe before, and we're actually going to South America here in a few months.
Right. When you go on a trip like that to South America, are you mostly looking for a party? Or?
Well, we're not avoiding a party, that's for sure.
The problem with Facebook is that people put up pictures and then tag you.
Yes.
So I had pictures of me with a whiskey glass on my head balancing it.
In Shanghai?
In Shanghai, which I wouldn't have published. Someone else
That's
published.
That's all for deal flow, right?
And then they tagged me, and then it's available for anyone to find.
Well, we like to think of Geeks on a Plane as really a cultural exchange experience around technology and entrepreneurship, and that involves us, putting people together who are geeks, who are entrepreneurs, who are VCs and investors. We do conferences, but then we also do social experiences, and I think it's a pretty common thread through most of 500 startups is that we're when there's game on, we're about business and technology, but we're also a pretty tight family, and there's a lot of social and community experiences that we think really draw and pull our family of companies together.
Doing business is about personal relationships. It's people that you know. It's far easier to build deep and meaningful relationships on a social basis. It's one of my observations. This is my maiden voyage South by Southwest. But yesterday, just walking around, you could have access to just about anyone. You see Dennis Crowley's over here. And the Union Square Ventures guys are over here. Dave McClure's at a bar hugging people. I mean, like, Gary V is here. Naval is here. And everyone's just out walking around, shaking hands, kissing babies.
Well, I mean, there's something of that which I think is the VC profession is, an open marketing
Yeah.
sort of opportunity where you need to sell yourself and your brand and what your value is to the community. But I think particularly coming from the geek community and being a programmer and, sort of helping do that at PayPal, I think, participating in what's going on is a really important part of being in the investment community.
I would say to you, Dave, I think the opposite is almost true, which is the overwhelming majority of VCs don't get out and do this social stuff like this and really put themselves out there and meet companies, use products, whatever. I mean, I must have downloaded 5 or 6 new iPhone apps of people who just wanted me to pitch their product, to see their product. And, that's been phenomenal for me. I don't think that many VCs do that.
I think it's getting to be more that way.
I think it's an entrepreneurial trait. And even for entrepreneurs, if you want to get access to senior people at Twitter, Ryan Server's here, if you want to get access to people like that, it's far easier to do here than it is booking a meeting in their office in San Francisco.
It is, but I mean, I think that's why, we do a lot of conferences and we work directly with, major platforms, is because that's where we see a lot of advantages, and that's how a lot of our companies are built, is, working with Facebook and Twitter and Google and YouTube and LinkedIn and, companies like that, even Apple, and in the future, Apple and Android and iPhone are going to be huge markets. So, we think it's important to understand those platforms technically. We recruit our mentors from those companies. We have investors from those companies. And then we really try and build strong relationships. We have 5 of our mentors are from Facebook. I think probably, more than 5 from Google. Yeah. Really building that community aspect tightly with the companies and the people we invest in.
Do you take medicine for Tourette's syndrome?
I don't know what the fuck you're talking about, Mark.
I teased one F word out of him. Why do you like to be so controversial? I mean,
why do I like to be controversial? I don't. Well, whether I like it or not,
you are.
I am who I am.
Right.
I mean, I believe in transparency, and so I'm not gonna dress up in a 3-piece suit just because. I mean, maybe if that's gonna make other people feel comfortable, I'll do that. But
I don't know if you can see it on film. He's got like these open-toe shoes. He wore these when we met Hillary Clinton. That was embarrassing. I put on a jacket.
That was embarrassing?
Yeah, I'm like, okay.
I mean, we were a bunch of geeks meeting HRC.
But you are who you are.
Right. I mean, I'm comfortable in my own skin. I think that's part of what Silicon Valley and technology is all about, is just being yourself. And when I write on my blog, when I tweet, or when I use Facebook, I mean, I may occasionally be putting on a show for performance sometimes, but I like who I am, and I'm not going to try and change that just for marketing purposes.
Right. Do you think something's fundamentally broken with venture capital? Is that because you have a lot of criticisms for our industry?
I think if the industry average is negative IRRs over the last 10 years, then I would have to say yes.
Yeah.
Although some of that's always been the case.
But you also then would be arguing that there's a fundamental problem with NASDAQ and S&P 500 and whatever. I mean,
well, there's downturns and there's upturns. I mean, so I think there are great venture capitalists that are both large and small, and I think there are great venture capitalists who are both technical and non-technical.
Right.
But I will say that I think in the last 10 years, the direction of the market has been less capital-intensive businesses, a lot more opportunities for distribution, and I think the industry has gone the opposite way. In that, after the dot-com crash, you didn't see less venture capital being raised. You saw more venture capital being raised, bigger funds being raised, when I think generally speaking, startups needed less capital.
Right.
For production costs, certainly, and in the last 5 years for distribution costs, I think that's even become the case.
Do you think we're in a bubble? Do you think that prices are too high, or
a little bit? I mean, I think prices are higher.
Yeah.
Depending on company, I think it's not as irrational as it was 10 years ago.
Yeah.
There's definitely some fucked up things going on that I think were driving really irresponsible behavior in the investment banking community and bringing companies to market with no revenue and no potential that were being bought. I don't think you're seeing that these days. So I think most of the liquidity environment is rational. There's some irrationality to maybe the M&A and IPO environment, but it's not super crazy. But I think there are very expensive deals happening right now. Probably more at Series A and B than at Angel and Seed, although prices are higher across the board. Primarily because I think there are large funds that need to put capital to work.
In the wake of Yuri and Ron doing uncapped, unpriced rounds, do you think that's a trend? Are you starting to see more of that?
I don't think that's a trend, but so I think that was a really smart deal. I think Ron and David and Yuri were brilliant for putting that together, and I think they're going to make money on those deals. I have a feeling those investments will probably settle into probably between $7 to $10 million valuations, maybe up to 15.
Right.
But Paul Graham does such a great job with filtering and selecting those companies. I'm pretty sure at least a third of those companies will be successful, and they'll probably be successful at greater than 3x the valuation. Yeah. So I think they're going to be that's going to be a great bet for them. I don't think the rest of the industry is going to be able to raise at $7 to $10 million valuations.
Right.
But prices are going to be higher. I think what is happening is there's a lot of competition for deals at both seed and later stage. Are you
finding it harder to get access to stuff?
Maybe I'm being a little arrogant, but no. I think because of the things that we're doing, I had a very specific strategy to go do things that I thought were valuable for technology founders around design, around distribution, around platforms. And I think we're asked into a lot of deals by both investors and entrepreneurs because we're differentiated. And I think that's going to continue to be the case.
Let's take our final couple minutes. Tell me a couple of companies in 500 startups.
Okay, well, I think there's a couple things that we are really big believers in. One is these devices, so iPhone and iPad. Yeah. Nothing against Android, but I think Apple's done a tremendous job in building an ecosystem that's great on both distribution as well as monetization.
So any investments you have that are relying on that?
So in particular, there's a company called 955 Dreams that did a History of Jazz app, which is probably one of the most beautiful apps you'll see on the iPad.
Okay.
They came out a couple months ago.
What is the History of Jazz?
So History of Jazz is a timeline-based application that allows you to kind of learn about music in the jazz industry, in the market. And it has a collection of music and videos and content, and allows you to purchase tunes from iTunes. Beautiful UI, so again, very design-centric set of founders and experiences. They were the top music app on the iPad for several weeks, and even actually in Japan.
How much does it cost to download the app?
This is $9.99 for the app, so not a cheap
What's
app.
What's the age demo it's targeting?
Probably 15 to 45, I think. Okay. We're investors in the company with Mitch McClure, and he also agreed with us as one of the most innovative companies in design.
He was the founder of Lotus.
Founder of Lotus, and also a very active investor.
One other company. What else are you?
So another one is a company called Kush, which does La-Di-Da, and they do a reverse karaoke sort of service for the iPhone, so you can record your voice even if you're a shitty singer.
Yeah, I would fall into that camp.
And then their music algorithms will basically match your crappy melodies to other things that actually are pretty good. Right. And I'm going to play a song from my 4-year-old. I don't know if we can hear this or not, but let's see if I can turn it up.
Maybe put it near you.
That's my 4-year-old singing Twinkle Twinkle. She wasn't being backed up by a band. It's like she sang that with no accompaniment. And then they auto-tuned her voice in a way that's similar, and then backed it up with vocals.
Auto-tuning is great. What's the name of this?
The
Ben Intruder song, like that one.
So that app is called La-Di-Da.
Okay.
And they've sold millions of downloads already. So right out of the gate revenue. They do.
Okay. So the theme for you're not afraid of music. You're not afraid of categories that other people.
I am afraid of music that doesn't make money. I like businesses
I was going to say, as long as people focus on revenue. And these businesses may be companies that one day are worth 20 million, 30 million, 40 million. They don't have to be $1 billion for you to be happy.
I mean, that's certainly fine for us. I mean, I think those are great stories for the founders too. I think we do have the potential where some of these businesses really can generate a lot of value. And companies like Twilio, I think, are definitely going to be the higher end of that as well.
Good. Well, Dave McClure was my guest this week from 500 Startups. I hope you enjoyed learning a little bit more. And we'll save all the controversial stuff for when the camera's off. So thanks so much for coming on. Appreciate it. Cool.
Great.